That was weird. Like, I didn't expect NFTs to take off. I didn't expect meme coins to take off. I think the big innovation in blockchain is actually that you can create programmatic market makers through AMMs and all these kind of clever curves that eliminate a lot of the layers that you have in TradFi that are necessary to get to run TradFi based trading. My feeling with MEV was that we need to maximize competition. So users always have the option to go to the best source for their trade. Whether that means that validator is maximum sandwiching and then giving everybody a rebate, that could be one model that actually works. If there's truly an exploit and you continue running the chain, even if you allow like DeFi and liquidations to run, they're mixed in with exploited transactions. As Ethereum folks, I don't know if you're around for the DAO hack. The only reason they were able to deal with the hard fork is because it was locked. All those funds were locked up in a smart contract that couldn't exit. If they started getting mixed with a whole bunch of things, like, it's just impossible to unravel. You can't roll back the real world. There's action that's staking in the real world based on the chain state. Circle is sending funds out based on like mint and burns, right? I think once you have 4 clients, you could say that the probability of a bug in 3 is so much smaller than the probability in bug in 2 that it's fine for one to be down. And then you can do this kind of maintain some liveness while one is down and rotate.
Welcome to Epicenter, the show which talks about the technologies, projects, and people driving decentralization and the blockchain revolution. I'm Brian Crane, and today I'm joined by my guest host, Martin Kröppelmann, who is the founder of Gnosis. And we have a very special returning guest today, Anatoly, the co-founder of Solana. Of course, Solana needs no introduction, so we're excited today to talk, get into the weeds a little bit of where Solana is at, what's coming for Solana, some of the challenges. So really excited for that. And now, just before we go into it with Anatoly, we want to share a few words from our sponsors this week.
If you're looking to stake your crypto with confidence, look no further than Chorus One. More than 150,000 delegators, including institutions like BitGo, Pantera Capital, and Ledger, trust Chorus One with their assets. They support over 50 blockchains and are leaders in governance on networks like Cosmos, ensuring your stake is responsibly managed. Thanks to their advanced MEV research, you can also enjoy the highest staking rewards. You can stake directly from your preferred wallet, set up a white label node, restake your assets on EigenLayer or Symbiotic, or use their SDK for multi-chain staking in your app. Learn more at chorus.one and start staking today.
This episode is proudly brought to you by Gnosis, a collective dedicated to advancing a decentralized future. Gnosis leads innovation with Circles, Gnosis Pay, and Metri, reshaping open banking and money. With Hashi and Gnosis VPN, they're building a more resilient, privacy-focused internet. If you're looking for an L1 to launch your project, Gnosis Chain offers the same development environment as Ethereum with lower transaction fees. It's supported by over 200,000 validators, making Gnosis Chain a reliable and credibly neutral foundation for your applications. Gnosis DAO drives Gnosis governance, where every voice matters. Join the Gnosis community in the Gnosis DAO forum today. Deploy on the EVM-compatible Gnosis Chain or secure the network with just one GNO and affordable hardware. Start your decentralization journey today at gnosis.io.
Cool. Well, thanks so much for coming on, Anatoly. It's really great to have you back.
Yeah, thanks for having me.
So I wanted to start off with, the original Solana vision, right, from, now it's like 7 years ago or so, was to have blockchain at Nasdaq speed. And, at the time, Solana was really pretty alone in trying to do a blockchain, single chain, high throughput, maximum performance, speed. At the time, sharding was like the hot thing when it came to how to scale blockchains, and you guys were kind of alone. Of course, today, Solana has gotten lots of traction, and also the idea of single throughput chain is something that's gotten a lot more traction with a lot of other companies pursuing something similar. But just sort of zooming out, like when you think back to your vision at the beginning and where it's at right now, how do you feel about it? What do you think are some things that, happened like you planned? What are some things that maybe haven't worked out?
Yeah, I mean, a lot of stuff kind of came true that thought would, but just in different order. Like the order was unpredictable, and the applications were unpredictable. We thought that trading was going to be a really important use case, but we didn't think it was going to be the most important use case. I think, to me, that's pretty obvious that like execution of and launching assets and execution of the trades between them is what's driving most of the volumes and revenues for across all the applications and block and layer ones and layer twos. This is where all the fees come from. And if you don't have revenues, you can't, no matter how many tokens you launch, you can't afford to pay all the L6 engineers. So somebody somewhere has to figure out how to make revenues. And I think that came true. What surprised me was that how slow TradFi was adopting this stuff. I expected like stocks and all of these things to be the main usage. But right now it's basically like gaming. Like it's NFTs and meme coins are like, if you look at Twitch streamers that are streaming trading, it's exactly the same content as when they're streaming mobile gaming or any kind of game. It is effectively gaming. It's just kind of PvP loot box. This is what how I think of it. That was weird. Like I didn't expect NFTs to take off. I didn't expect meme coins to take off. But they're using the same technology. It's the same kind of escrow auction processes on chain. I thought like central limit order books would be the killer way to run markets on chain, but I think the big innovation in blockchain is actually that you can create programmatic market makers through AMMs and all these kind of clever curves that eliminate a lot of the layers that you have in TradFi that are necessary to get to run like TradFi based trading. And that's pretty interesting. And even if the AMMs are less efficient, the costs that you spend on professional market makers like Citadels and Jumps are so large that you might actually, as a early stage company, you might be better off using an AMM, to be honest, versus like the more professional TradFi approach. That was unexpected, and I think that's a legitimate innovation. I think where you see the explosion of assets and how they're traded, it's primarily through automatic based kind of market making approaches like curves and bounding curves and AMMs and stuff like that.
I would like to jump in on a topic you hinted at, and I think it's people have very different opinions about it. What makes blockchain valuable? You mentioned fees and said, somewhere there needs to be fees. And I think at least in Ethereum land, there is kind of this debate between should Ether be just money and somehow that's where the value comes from, or should there be transaction fees? It seems like you have a very clear answer here.
I'm traditional conservative. You have discounted future cash flows that would give stuff value. There's exceptions to that, but I think they're the outliers. You can't engineer for them. This is the problem that I have with like, oh, Bitcoin is so successful, therefore we must build a better Bitcoin. I don't understand the engineering reasons why Bitcoin is successful, so therefore I cannot build a better Bitcoin.
So would it be fair to say the number one, or kind of one absolutely crucial success metric for Solana is overall fees?
Yeah, I think the network needs to have enough fees to pay for all the engineering effort and the validators and all this stuff. If it doesn't have that, I think it will eventually die. That's kind of my belief.
So where do you think what will be the scarce thing that people will pay fees for? So, I mean, generally speaking, is it just general block space, or you would say block space in general will be more or less free, and it's specifically congestion block space or congested block space? Or?
Yeah, I think what the value that these systems provide is they have state that has an economic opportunity with cost and the prioritization to access that state. And this is where you can charge more than the hardware and the bandwidth and all the nuts and bolts. And if you're purely selling hardware, 1,000 replicated amount of storage or whatever, you can only charge so many more multiples off the cost of the hardware, like maybe 10x. Otherwise, a competitor will just underbid you, and you will lose this way because hardware just constantly keeps getting cheaper and cheaper, and your dominant costs are always going to be the people, right? Like it's just at the end of the day, it's you got to pay for all the engineering stuff. So this is where I think like probably again why Solana has such a different roadmap than Ethereum is that I think that the network cannot survive without the execution layer also paying for all the costs to build the data availability and all this other stuff. The execution layer is where you can charge real fees based on content, and everything else has to support that.
So what you just said, kind of priority access to economically important content, kind of MEV, right?
Yep. Yeah, absolutely.
So one theory people have been discussing is that MEV was, or definitely in Ethereum for a while, it was very much captured by the chain and by validators. But to some extent now it seems to be moving more towards applications, or in principle applications have the power to kind of add extra rules on top and kind of protect their MEV. Do you see that as a danger for Solana in that case?
No, I think it's the goal for Solana is to so there's designs for application sequencing. I actually proposed one a while back called program writable accounts. I don't know, Brian, if you were involved in shooting down that SIMD. But basically the idea is that I felt that it's important for apps to be able to set the cost to take a write lock on their state. So that economically important state that's important to access, if the application can say, hey, to be able to write to the state, because access really means write, to modify it, to take that offer. I want to set the fee and have that fee be application specific and dynamic and controlled by the business logic of the app. That would eat into some of the fees that the chain captures. But what's good for the goose is good for the gander, basically. That system would preserve atomic composition between applications and the cross-atomic, all the arbitrage between all the apps that are extremely profitable. That you cannot remove, right? If each application then moves off chain and runs their own L1 or L2 or whatever, their own separate environment per app, then you lose that atomic composition and you effectively lose those revenues. So what I want to see is the L1 Solana, this giant atomic state machine, its revenue to be mostly driven by the opportunities that arise from having everything in one giant state machine that's synchronous, that's fast, that's as cheap as possible, and then give the application the tools to capture whatever fees they want, and they can tune them, set them higher, lower, distribute them to the token holders, distribute it to the makers instead of takers, prioritize cancels instead of other orders. So a bunch of whatever they want to do, I want to leave that to the application layer. And this is, I think, where Max Resnick and I really mind melded, because at a gut level, I thought that we need multiple block producers at the same time to create a dynamic market that's competitive for people to accept these transactions. And he kind of came from a more economics research angle, where he saw that if you don't have multiple proposers, then applications cannot really build these value capturing systems at all, because the validator will be able to effectively censor. And if you're censoring all the inputs that are going into this application specific sequencing thing, then you can effectively control the fees that the app sets anyways. So what you need is you need both of those pieces. You need the hooks in the system for apps to be able to set their own fees. And you need the competition between block producers. And I'm 100% on board with all those changes, even though on the surface they seem to give up some of the economics to the apps. But the goal is, if we have all the apps in one giant system, the economics between all the cross application arbitrages are going to be way more than enough.
So with regards to MEV, I think you've always had, in many ecosystems, people have been like, oh, MEV is a bad thing. We need to minimize MEV. I think you've always had a more positive view on MEV, or like, how do you view MEV, and how do you think MEV is going to develop with those changes in the future?
Look, a market maker submitting their cancel before everyone else is MEV. They're getting priority access to state ahead of everyone else. They're paying for it to the exchange or to the whoever, right? That is MEV. But that creates better markets, because then the market makers can have tighter spreads. So my feeling with MEV was that we need to maximize competition. So users always have the option to go to the best source for their trade. And whether that means that the validator is maximum sandwiching and then giving everybody a rebate, that could be one model that actually works. That's fine, as long as it's competitive and the users can make that decision. And I suspect that each individual user is unlikely to make that decision unless they're a pro. But like Phantom, that wants to serve the best possible blockchain to their users, that's competing with Soulflare, with Backpack, will make the informed decision to go with a particular solution for how they route their transactions and stuff. But we need competition for that, for all that to work out. So my view is that the stuff isn't all that different than I'm selling block space. I'm buying block space. For me to get the best offer, I need a healthy market of buyers and sellers. That's kind of the basics that we need.
So in Ethereum, proposed separation, right, was chosen a few years ago, and it's the state today. What do you think about Solana? Do you think we will also end up with proposed separation, and is it something desirable?
I don't know if there's anything we need to enshrine for that to work. It's kind of happening right now. I don't know if there's changes to the, if you need enshrined bundles, I don't have any objections to those. What I do care about is concurrent block producers. So multiple concurrent proposers or multiple concurrent leaders, that we have two validators, one in Singapore, one in New York, that are running there, that are both accepting transactions, and the user has the option: do I send to the closest one in New York, or maybe one that's further away that's offering a better deal? And if I'm a market maker and I need my cancel to land, what that means is that I can send to the one that isn't censoring, and the network, the actual enshrined protocol, needs to support an ordering mechanism where I can pay the network within this block. I'm paying a fee to go first. So does that make sense?
Yeah, I think that's definitely one of the topics. I know there's a huge focus for you, and I think currently in the Solana developer thing is this multiple concurrent proposer. So for you, the main reason why you want that is because you want competition between validators, and you want basically less ability for validators to kind of, gouge the users, or
It's also a beautiful thing, because this is a way for a truly decentralized global blockchain to beat TradFi, to beat Nasdaq on actual pricing. And this is a very subtle thing that changes here, is that if you think of the network or any exchange or any of these systems as reflecting of the world state, and there's an error between that state and the real world. And constantly people are trying to reduce that error by submitting trades. They see a price that's offered, they have information in the real world, they're trying to close that error. And if some event happens in Singapore and there's a local leader there in Singapore, the latency for me to submit that trade is much, much shorter than to send it all the way to New York. So for Solana as a blockchain to compete with Nasdaq, we need a block producer in every spot in the world that has any economic activity. So then the user can submit that transaction locally and cut that latency.
But I want to understand that because or at least in Ethereum, you have for an upcoming block, you have exactly one proposer, and that one might sit in New York, they might sit in Singapore. So in Solana, it sounds different, or is it still the same concept?
Right now, that's exactly how Solana works, but there's no reason why you can't have two proposers or N.
Okay,
currently.
but then let's say, okay, so now on the same slot height, block height, you have now two, one in New York, one in Singapore. So now let's say they would have two conflicting transactions here in one. Then how is this merged, or how is this resolved, this conflict?
There's a deterministic merge. So we need that. It has to have that property. And two, if I want to go first, I should burn some soul to be ahead of somebody else.
And this merge will be on the whole block level or on individual state? Probably.
You can think of it as a block that is a chunk of data, right? 1 megabyte, 2 megabytes, and the first half is written by proposer A. The second half is written by proposer B. The network receives the entire block and then runs a deterministic merge to compute the result.
I see.
But you can have any number of these proposers. The main constraint is basically, we don't know until we test, is how many shreds we can propagate through the network. And shreds is our term for erasure coded chunks of the block.
But it also means that if the transaction hits your local proposer, at that moment you don't know exactly what happens. You then need to wait for kind of some second round or the merge round, essentially to.
It's not a round. Once you receive the data from the block,
from the others, right? Then you can locally.
Yeah.
I see. Yeah.
So the network could effectively, the latency there isn't really lost, because as soon as the network receives the data, it can vote on confirming that the data has landed. So as soon as you see the confirmation, you can compute the results, and you don't need to wait for everybody to compute the result and confirm that, because that part is deterministic. You obviously, like if you're a professional like system like that, it's like a custodian or a bridge, you might want to run different boxes with one Firedancer, one Anza, make sure all of them agree on the results.
So essentially, the blockchain would then become a DAG, right? Or what is it, directed acyclic graph?
No, it's different from a DAG. DAGs resolve their ordering based on the next producer that then decides the ordering of the previous transactions. This, you have literally concurrent leaders. It's no different. It is like leader 1 writes the first page, leader 2 writes the second page, and then you mix them together. The shuffling here is enshrined and deterministic, and that's different from the DAG. It's not dependent on the next producer.
So if you have these two proposers, and let's say there's some arbitrage opportunity, and now people with both proposers put in transactions that both try to capture the same arbitrage opportunity, then basically it will get merged, and then whichever is the first one actually gets executed.
Yep. So the highest burned one, the one with the highest burn for fees will execute first.
Okay. What's the hardest thing about making multiple concurrent proposals happen? What are the problems that you need to solve?
The stability of consensus, basically. Like, it's just the implementation is like prone to outages, I would say. I don't think it's design-wise any worse for the worst case, because consensus mechanisms all deal with a single leader that produces two different blocks. They all have to resolve that. Even if you slash that leader, right, you still don't want to have an outage in case that you have a bad leader. So the worst thing that you want to do is have a performance segregation. And slashing for performance degradation is fine because then you reduce them in practice. But you still have to deal with it no matter what. So in an environment where you have two leaders, the network will see 4 different views potentially of the results of the block. Only leader A, only leader B, neither or both. So, and the deterministic shuffle will be different for each one, right? If you only see data from leader A, then you just take leader A's block. If you see both, then you shuffle. If you see neither, then you skip. And this is the complex part. What you want to do is you want to make sure that there is no partition in these views. So every time they vote, they take the happy path. It doesn't matter what partition they see, as long as everybody in the network sees the same thing. If everybody sees that leader B failed, that's great. It means that they all agree on the vote and that you continue doing on the happy path of the consensus rules. And Solana, like we built our consensus. It's very complicated and a pain in the ass to work with. But the properties that it has that previous systems didn't have is that it was bandwidth efficient, that you have a block on every point in time, that there was no stalls waiting for rounds to finish before the next block starts. We now see systems like I think Aptos and Sui have gotten that to work with more modern consensus algorithms. There's a whole team from Zurich optimizing and basically getting rid of all my technical debt to have like a better version of consensus on Solana. And again, we can maintain a bandwidth efficiency and we can deal with all the partitions.
Then talking about, efficiencies, what are currently the bottlenecks, or what's currently the bottleneck for scaling in Solana?
It is basically, you've seen like, I think like Eclipse and a bunch of other kind of Solana SVM based layer 2s tune up the compute units. So basically the bottlenecks is making
wait.
that
you need to help me here. So say again.
There's a whole bunch of not Solana layer 2s, but layer 2s that use SVM.
Okay.
Some may even be Solana layer 2s. I don't even know what the marketing. I don't know. I don't even know which state root they're looking at. Is it Ethereum's or Solana's? It doesn't matter. I treat them all as competitors, because if the fees accrued there are not accruing on Mainnet, they're not paying for Mainnet development. So, and they're fine. It's all good. We're all building open source software, so it's like Red Hat versus Ubuntu. It's healthy competition. But they've been able to increase their block capacity, I think, by factors of 5 to 10. So it is basically the blockers is just testing. It's just making sure that when Anza or in Firedancer increase the capacity, that there isn't some I call them like they're denial of service attacks. There isn't some metering problem in the VM or in the block or whatever that an attacker can exploit and create a block that takes 10 times more to process than normal. These are basically like the worst case kind of scenarios that are pain in the ass to find.
Let me just repeat, because I'm not that deep into Solana. So you're saying, yes, there are versions essentially of Solana, the SVM, that already run at 5x the capacity of what Solana does right now, and it kind of works, but you are slightly more conservative, and
we have to be, right?
Those are not decentralized, right? They're basically roll up like.
But even doesn't matter. They're earlier, they can take more risk. That's the difference. If we were just starting out, I would tune the network to 10x performance and deal with the fires. Like, that's the difference.
So, I mean, the other point you were making is that you would say kind of L2s are not really interesting, you would say, to Solana from an economic or fee perspective. So
they're not interesting to me.
Yes,
there's people that they're interesting to, and that's fine. But what I want is Mainnet to succeed, right? So to me, what matters is activity on Mainnet, trading on Mainnet.
So essentially, the whole idea that kind of the Ethereum idea that somehow you would provide a blob space or kind of data availability or transaction ordering, and then other use it for other space that you don't
Ordering,
think is
if you could do ordering, then yes, but there isn't. I think the based rollup thing is still not fully defined, and if the chain is doing ordering and DA, the based rollup, the only difference is then like a different virtual machine or something like that.
I do very much agree with you. So I am also in the I'm kind of in the Ethereum camp of if rollups, then it should be based rollups, because I feel like if Ethereum is trying to sell something, it cannot just be generic data availability because that's a commodity. It needs to be specifically transaction ordering.
We already have based rollups then. Like there's already like ZK proved Merkle trees or like classically proved Merkle trees with leaves for state.
To me, the interesting thing about based rollups is that they kind of still have this atomic composability, or you can have atomic transactions that touch L1 and L2 state. And the advantage is, I think it's fair to say, okay, you still have some validators that have all the state, and then it almost doesn't matter whether that's on the L2 or on the L1. But if you care about being able to have lower perform or kind of have validators, I mean, well, here's my dep node sitting next to me that runs Ethereum, and I can still do this from home. If you care about that, then it does make sense to say, okay, some state that kind of exists, but it doesn't have to be available to anyone who's running a validator on the L1.
There's already sort of stuff like that running on Solana. So Metaplex built this thing called compression. I don't know if you saw this terrible marketing name. I came up with that. But it's basically a Merkle root that's on chain, and you can atomically prove the data exists in this tree, and another piece of data exists in a totally separate tree. Push them to the L1 state, run a computation on them through a program like a token swap, and then push them back into the trees. All of this in a single atomic transaction. So the state that is effectively cold can be offloaded and run programmatically in these Merkle trees. And the primary thing that they're used for is like NFT, like you mint your 20,000 NFTs, you can instantly like mint them in one batch or one Merkle tree, and you just register the leaves with the chain so wallets and stuff can pick them up. And there's now a ZK based approach to make the proof smaller and a bit more composable. But that part is like the easy part. I think the based rollup is a bit more a bigger piece of technology than that. It involves developers defining their virtual machine and the state transition function that connects their VM to the state root on the L1. My problem with those is that there's just no need for that many VMs. Like, I'm sorry.
Frankly, I would also kind of for the base rollup say just do EVM and
But then what's the point to have like a dozen different EVM based rollups?
The point might be to reduce, to kind of still allow people to, run relatively lightweight L1 validators. And kind of say, if you want to do the full thing, then you run the L1 and the L2s and have the full state available.
But how's that any different from like I have a program that has like a dedicated circuit, like a ZK circuit, and I just prove that program. Like I don't need any VM, general purpose EVM. I have like my minimized whatever the like Lego piece of a smart contract. I just prove that smart contract only, and now I have a way to route data through that thing, through the L1. So you have your transaction, it proves the state, calls the contract, right, with the proof, calls another one, and like a series, and then it's done. So that's effectively like the old stateless like design, right? Like Like what is the difference between that and a based rollup? Like why aren't based rollups just simply smart contracts?
I think you can view it as that.
Yeah, then like those already effect kind of exist with some traction. Like they're useful for, I think, like large, like if you're trying to airdrop to a very large user base and that kind of thing, people have found tractions with that, but they haven't found traction with like what I think is kind of interesting that you see that works well is like Jupiter, Radium, like even Pump. All these things are all really, really tied together in the execution, and you can see in the transaction that a single transaction will hit like 5 different markets all at the same time. And we haven't seen like anyone be able to build a ZK based or something that is truly off chain that still plugs into the atomic execution piece for trading.
So let's talk about Firedancer and sort of Solana clients, right? So Firedancer's been in the works for a long time, aiming to, speed up and remove a lot of the performance bottlenecks in the client. What are your thoughts on, what the impact will be on the network? And do you see in the future, you want to see a bunch of different clients running in Mainnet at the same time?
Do we need a bunch? I think 4 is what people is like 4 or 5 is like you kind of need. Technically, you should have 5 for BFT so you can do maintenance on one, and then you still have reliability of one going down without a liveness failure. That's like the dream, but you just get an astronomical improvement on safety when you have 2. Like because it's just such a. This is the thing that keeps me up at night is like some bug that auditors and testing and all that stuff missed. That's a critical vulnerability. That's a 0 day that could steal everyone's funds. That's the scary part. You have 2 separate teams that built the same code. It's very unlikely that they would have the same bug in both code bases that can be executed the same way at the same time. So you have some redundancy there that's just really, really critical for these systems.
But if Firedancer now is, can process more transactions, then, I would expect that all of the validators will switch to that, no? Because they will earn more fees. So
no, it's the limits are set network wide to make sure that both clients can run it. And
okay,
Agave is not a slow client. You can actually just you can literally just remove our limits and then run it at like 10x capacity. Right now, there's no the limits are there to kind of slowly, like there's no fire to increase block space, because even like during the worst case day with like Trump coin launching, the median fee was like 15 cents a transaction, and this is when the network is doing 40 billion. Now that's high, and if that was sustained, they would become fire. But that being the worst case, like peak demand, that was 10% of Nasdaq's volume. That's actually really, really good in terms of fees. So there isn't a fire. There's a reason to increase block space that I think is more long term. And what I care more about is that like every release bumps block space by 20-40% versus them getting 10x in 2 years. Like as long as the developers are pushing themselves, like, hey, what is the bottleneck that is keeping them up at night that could be exploited or whatever, they write the test, they get comfortable with it, and then they tune that parameter up. This is what I want to see, more so than like let's 10x and then see what breaks and have like a bunch of weekends where everyone has to go like fight fires.
You mentioned the security improvements from having a second client. So how would the network behave in different scenarios? Let's say 10% of the validators would run, or let's say Firedancer is new and only 10% run it.
We need more than 33% run by the minority client. So it doesn't matter where, but as long as the smallest client has more than 33%, then the network would halt.
Right, it would halt. Okay, I see.
And that's okay. We're not Ethereum. This
Yeah. And you see this as preferable. So you would say
Yes.
if there is a bug, then it should halt. Yeah. I see.
Yeah. And people can quickly fix it, and it's an egg on everyone's face, and it sucks, and it should never happen. And there's a lot of effort to put into make sure it never happens. But if there is a exploit, then yeah, please halt like right away. And then people can go fix it. That's the preferable outcome to anything else. Because like, I mean, if there's truly an exploit, and you continue running the chain, even if you allow like DeFi and liquidations to run, they're mixed in with exploited transactions. Fucking that state, the resulting that state is a nightmare. It's like it's worse than a 18-hour outage or whatever. Like as Ethereum folks, I don't know if you're around for the DAO hack. There was the only reason they were able to deal with the DAO with a state like with a hard fork is because it was locked. All those funds were locked up in a smart contract and couldn't exit. Once if they started getting mixed with a whole bunch of things, like it's just impossible to unravel. You have like somebody launches a meme coin, the attacker launches a meme coin, buys it with the funds, it's mixed in with a whole bunch of liquidity. Like you cannot like really untangle that in any sane way.
Yeah, you'd have to like actually roll back, I think, and reset from an earlier state probably.
Yeah, and to me that is far worse than just a hard liveness failure. Because that like you can't roll back the real world. There's action that's taking in the real world based on the chain state. Like Circle is sending funds out or based on like mint and burns, right? You can't like tell them, hey, go roll back these transfers. It's better to halt. This is like I think in all these cases, like it's basically better to halt. I think once you have 4 clients, you could say that like the probability of a bug in 3 is so much smaller than the probability in bug in 2 that it's fine for 1 to be down. And then you can do this kind of maintain some liveness while 1 is down and rotate. But yeah, the terrifying. This is like the worst nightmare.
Well, I wanna ask another, maybe a little bit more on the scaling thing before we go to security. What do you think is possible here? Like if you think of like, I don't know, 5-10 years ahead, where do you want to see Solana in terms of throughput? And do you think it's feasible to basically have Solana scale to such a level that it can absorb, kind of like, or it can satisfy like all the demand of the world in terms of block space?
Our blocks right now are like 2 to 4 megabytes in size. The New York Times website is like 20 megabytes. But my very mediocre goal is to get blocks to the size of the New York Times website. Like you don't even need the crazy 2D erasure code sampling for light clients when your blocks are the size of the New York Times website. People can just download full blocks to their phone, and nobody like you don't need these like next generation technologies yet. So and that would be like a 10x increase. And is that enough to handle the entire world? I think somewhere between 10x to like my belief is that like you look at Google, they when their estimated searches per second is somewhere like around 50,000 to 80,000. That's a fully globally scaled web application that is fully permeated the entire world that people use constantly. And people use finance a lot less often than that. So like 100,000 TPS in a single one would cover the 99% of the most important financial transactions for sure. So somewhere between like, one 10x and another 10x, I think that is actually probably as far as crypto needs to scale. it sucks to put limits on it, and people feel like, oh, you're being so pessimistic. But like, I pray that all my competitors are designing for infinite demand. Yes, that is like the worst engineering trap. And I don't even tell Lonzo people to 10x the capacity. What I tell them is like, just 2x it this year. Just think incremental improvements that you can ship confidently, and then 2x it again next year. And just like that's how you get to like the scale that is needed for demand.
So I know one project that's gotten a little bit of attention. I think still very very early is DoubleZero. So where they're trying to create this private fiber network. Do you think that's going to be needed?
Yeah,
Or
it's not really fiber, and this is maybe I can explain to folks how it works and why it's not scary. Basically, there's nothing you need to change about fiber. The cables are all basically the same for like the last 30 years. And light is very fast. What the differences are is the signal processing in each end. The switches that like handle that load, the way they're designed for throughput is with big buffers, and those buffers increase latency. And finance and us, right, like effectively part of the finance world, we want to have the lowest latency possible. So what we need is different kinds of switches. So every data center in the world, you can just go and tell them, hey, give me this switch. I want a super low latency switch. I want this dedicated lane. And somebody has to go do that work, to go do those deals, talk to the people and stuff. But in and of itself, it can be very decentralized. All these switches are in different parts of the world and different data centers under different ISPs. They can all be owned by different providers or whatever. So that part could actually be very decentralized. The fiber, no one's going to change that. It's already laid. So a bunch of the stuff is very much like in spirit of the internet and crypto, I think. But it is one protocol, and the goal is to use DoubleZero as an overlay, just to have if the network is running in the fast happy path, that all the messages, like when we need to send out votes, they can all go through the multicast super fast path for DoubleZero. If that fails, they're still going to arrive over the internet, 500 milliseconds later. But what we want is for the happy path, when everything is working, for things to be as fast as possible.
Cool. On the topic of then security, so on Ethereum, over the many years, there have been kind of a number of huge hacks and ways where people lost money. How so far has this been on Solana? What has been the biggest security incidents?
I think Wormhole was the biggest one, and that was a really unfortunate bug. This bug didn't exist in Wormhole 1, and then in the second version, they introduced this bug where you could fake the proof that there was a mint on the other side, and an attacker exploited it right when they posted the fix for it in their public GitHub. So the attacker was watching their GitHub and waiting for the balances in Wormhole to increase up to the as much as they could before they did the bug. So this is like a professional attacker. I don't remember for sure, but it might have been Lazarus Group. That sucks. Like this stuff sucks. It's hard to really fix. There's formal verification companies that I think similar approach to how they formally verify stuff on Ethereum is typically you recompile the code through LLVM, and you can use the intermediate output and run. There's formal provers that can run on top of that to test some properties. I have thought of like adding like the nice thing about Solana is the code is separated from state. So you could actually load, in theory, separate programs that implement the exact same state transition function, run them both, and then see if they disagree and then abort. Do we need that level of redundancy? So we have redundant implementations for smart contracts too. And obviously the user would need to pay for twice as much compute and stuff, but like compute is one of the easiest, much easier to scale than bandwidth. So like to me, that's almost like a no-brainer if it would help. So that's scary. I don't think Solana is any safer than Ethereum for new code. One advantage that's kind of weird is that because of some idiosyncrasies of SVM, people don't really write interfaces for smart contracts. So there's no ERC20 interface. There's an implementation of the token program, and everybody uses that program. So it's like as if you had one canonical ERC20. So that means that if you're a DeFi protocol and you only accept SPL tokens, there's no way for the attacker to create a bad implementation of ERC20 and steal funds from your users. So that has reduced a bunch of the kind of attacks that you see sometimes with like pool exploits or like bugs in the ERC20s, or legitimately like people making bad ERC20s to trick users. And that has reduced, I think, a lot of the composability friction, because then like you can build a company that doesn't write any smart contracts at all. You simply just reuse all these already pre-built Lego pieces, and they're all composable because everyone accepts the exact same implementations. And that's been interesting to see. So I don't know if Pump wrote their own bonding curve. They might have, but they didn't build the AMM. They didn't write the token contract. All those have been standard. Like I think they use the Radium AMM. So that's kind of like one of the examples of that.
Yeah, in Ethereum, I think we had seen first this class of, or kind of a bunch of, well, smart contract hacks. But very recently there was, kind of a new, very, very large hack that was not related to smart contracts directly, but rather to interfaces being compromised. And because, I mean, the reality is, if you interact with a somewhat more complex program, then you go to some interface, it essentially triggers a transaction that kind of on the interface promises you to do something. But of course, unfortunately, if the website or the interface is hacked in some form, it is absolutely, or at least in Ethereum, and I kind of would be curious
You're
about,
talking about Bybit?
for example, or I mean, for sure, So
You're
so
talking about
essentially,
UI interface, right? The user
Yeah.
interface, not the
Yes.
programmatic
Yes.
interface of the
yes,
contract.
it's user interface. User interface shows you you're doing transaction A, but to the wallet, it's sending some malicious payload. And the question is now, do you have any chance to understand in the wallet what the state change of the transaction will be? And kind of, is there a realistic chance to?
I don't actually think that this, I imagine this should be possible to do on Ethereum, but maybe easier on Solana, is that like, because you know which accounts are token accounts and the implementation of those tokens, they're all the same. What I've been recommending people, and there's a project called Lighthouse Protocol, is they add guard instruction that aborts if the resulting state at the end of the transaction is different than the user expects. So this would also protect you from like you write a transaction, you think you're hitting an AMM, attacker does a program upgrade that just steals your coins, right? So they fake the simulation. Like this is kind of like a classic attack. You simulate your transaction, looks fine, you submit it, but then something changes in the chain. Attacker sets a bit, right, and does something different. So to protect against that, you can add that guard transaction, and then your your cold storage system should have effectively rules and policies implemented in the cold storage, not relying on the human to go look at the trusted display and parse that string, that actually checks for that guard transaction and checks that the spending limits and all the policies that you want are not exceeded. This is what I have been like pushing people to do. And you can kind of get there, I think, with Keystone Wallet. They have a developer API where you can programmatically set some rule sets and stuff. But yeah, I think this particular UI hack issues are solvable through kind of more robust security policies around cold signing and stuff. I don't know if simulation is much more complicated on Ethereum, but if you know this is a cold storage system, you know that it should only be doing simple transfers. You know the accounts passed to it should only be token accounts. You can then add guard transactions that assert all that and assert the balances. And then when you hit the chain, it'll abort. Attacker did something or screwed up. The thing aborts, pager duty goes off. Everyone figures out that's like what happened, right? I think that is solvable with technology. I think stuff that's really hard, I think, is just smart contracts in general. Because the more interesting ones are like risk systems like Aave or Perps or any of these systems that are not just purely trading. They're managing risk. They have a lot of inputs like oracles, and the attack vectors there are not obvious, right? You have there's latency games and exit games between the liquidity bots and the capital and the contracts. Those are very, very hard to get right. And proving systems can't help there. But I think that these kind of high level smart contracts that manage risk, if they can scale, they're probably the most disruptive part to traditional finance, because this is the entire function of any bank or any fund or anything is managing risk. If you can automate it, and you can scale it up, I think that's very, very disruptive and very valuable.
So with regards to the smart contract security, I think today in Solana, a lot of smart contracts are upgradable, and it's also pretty common for smart contracts to be closed source. What are your thoughts
Don't
on
use
that?
those. Just don't use them. Just don't do it. You have the power as a user to not use those. But if you do have to use them, there's a difference between being an LP into a closed source smart contract versus trading in it. If you're trading in it, then use Light Protocol, which will guard your transaction if that closed source contract does something wacky, or there's an upgrade that happens in the middle of your transaction. You can actually protect yourself against that. If you're an LP, you're moving your funds into that thing and you're letting it custody your funds. You should know who the hell you're giving your funds to. Don't do that. Look for open source contracts. Look for formally verified smart contracts. Look for like multi-sigs with time locks. If they have to have a multi-sig for upgrade, make sure there's time locks on those things. Like, there's a whole bunch of things you can do to defend yourself, and you should ask the companies that provide these services to go do that and advertise that they are. But yeah, like, I think that part sucks, and a part of it is, I think, developers being lazy, or probably not lazy, they're just limited runway, limited time, trying to get traction. But I think as protocols mature, like, I think you really need to demand for them to kind of put in the work to level up their OPSEC and the security and the risk they expose their users to.
Do you think there's anything that can be done, I don't know, from your side or the client, or like, what can be done to try to accelerate this and try to get more open source immutable contracts? Or is it just a user demand type thing that it's hopefully comes with time and maturity?
It'd be good if there were like groups in the ecosystem that could kind of make a list of all the best practices, who's following them. Neodyme tried this with like security.txt in the GitHub, and that had some limited positive impact. Yeah, it's probably should be like a group ecosystem effort. It's hard to maintain those systems and like keep them up to date. So it needs, I think, like input from a lot of folks.
So we talked about economics a little bit before, but right now I feel like we've seen actually the most vibrant sort of governance discussion that at least I'm aware of in Solana. with this SIMD 228, right? That Multicoin proposed a change to the inflation, which would make it dependent on how much is being staked. Because I think right now, right, we've had this inflation that kind of gradually, slowly goes down with time. What are your thoughts, first of all, on this specific proposal?
Yeah, so I think the perfect way to have inflation is that like the network needs to get some stakers to run boxes and pay for the boxes running. And the only thing that the network can really sell is more tokens. So this is what the inflation piece. So if you were to run an auction, you can take the top best bids that are sufficient for you to run a secure network. And you don't know what those are. You kind of guess what that number is. But effectively, you can kind of run this algorithm. You start with 50%. You take the top best 50% bids to stake, and only those. And you offer everybody the same price around like a Dutch auction. And if that price is below zero, because people can bid a negative interest rate, they're willing to burn some of their tokens for the right to make blocks. You then increase the amount of stake that you want. So you're targeting zero. And if the bid is above zero, then you decrease within some limits that at a high level people think are safe. We've seen Ethereum run at like 20 to 30% stake without any problems at all, like in the security side. So I think having the lowest limit of 20 would be reasonable. And I don't see any marginal benefit above like 80%. So between 20 and 80%, right, this thing is bouncing around and people are bidding. Those bids effectively create a curve that looks very similar to the curve proposed in 228. Now there's an error there because the curve in 228 is fixed. There's this curve that, Max and a bunch of other smart people thought would be the best approximation. But that error between the market rate in all these dynamic environments and the proposed curve is going to show up as the network overpaying for stake. It's much, much smaller than the current setup. So my view is that like running these auctions and the complexity of telling users, oh, you need to pick a price and maybe you need to pick a negative price because there's a lot of block rewards. It's just so complicated that there's no way to really scale that up outside of like a few small professionals. And it's a pain in the ass to run. Imagine you as a validator that your stakers constantly have to bid like every epoch, no matter how long it is, right? Every 3 months.
It could be
even.
the validators bidding, no?
Sure. Could be the validators bidding, but it's still like a pain to run and manage that. I think my view is like, don't let the perfect be the enemy of the good. The proposed curve is a pretty good approximation of that process, and it's much, much simpler to implement. There's no auction. There's no like auctions themselves have a whole bunch of complexity that's gnarly, and running them is gnarly. So in general, I'm very supportive to 228. What I want to emphasize is that like Solana's never been a money. Like the point of Sol is to disincentivize spam. If that we have another 97% negative downturn in the market and it's the bottom of the bear and this curve is not working out, people will change it. That's okay. Like that, right? I think people need to understand that there isn't like this Bitcoin esque. We don't care about our grandfather. The sins of our grandfather don't bother us. Like it doesn't matter what Bitcoin did in their monetary policy. Solana can do a whole bunch of stuff that I think Ethereum is still stuck on in this trying to be money and like compete with Bitcoin that the Solana ecosystem is not. So I think this curve is an improvement, and I'm supportive, and I'm encouraging people to vote for it. And I think it'll reduce emissions, and emissions are, in a perfect world, emissions don't matter because there is no taxes and there's no middleman that can take a cut. But in the reality, like if you look at fees from custodians and centralized exchanges and the rewards, it's just like a huge subsidy. And that's not even counting the average global tax rate on those earnings.
maybe on this note, would you agree with the statement to say emissions are a tax on everyone who's not staking?
Oh yeah, the emissions themselves, it's just money moving around the black box, but it's not like the group of users that are staking and not staking are different people. You can literally be both at the same time.
Right. Well, yeah, certainly in Ethereum, there are some people that have a strong feeling there should be reasons for Ether to not be staked and just be held in Ether. And they see kind of staked Ether potentially as a threat to the whatever moneyness of those things again you don't really care about, or yeah. So would you say 90 or even close to 100% Solana staked, or be in the form of some staked Solana or something like that, tokenized staked Solana, that you wouldn't see as an issue?
If there's like UX issues around it, like that's what I would care more. I think I don't like when things hit the limit. Like it seems like there's a bug somewhere incentives wise. Like you don't need 100% staked.
Sure, no,
Yeah.
you don't need it, but the question is, wouldn't it be rational, or if staked, kind of a tokenized staked version is just so easy to access, then why not get the additional 1% essentially, or whatever it is?
Well, then why isn't the rate negative? Would be my question. Like if it's at 100%, then people should be,
Right.
then somebody's overpaying, right? So to me, it bugs my market, like free market thing more than like whether it's usable as money or not. It's like, it seems like the whatever curve you picked, it has a bug in it and has caused it to hit the limit point, right? So that's what you want to avoid. You want the parameters to be set somewhere where you're not at 0 or 100%. But like in general, like I don't think there's any threat to the moneyness of it, and I don't really care if Sol is used as money. If if there's 10 billion per day volume of ETH versus everything else on Solana, it's great. We hit PMF. There's real activity. Like why would anyone be upset? Trade more ETH. I don't care.
Cool. I think you started with saying that some things came as expected, other things, specifically the use cases, did not came as expected. So maybe making an outlook for the next couple of years. Do you think that those finance use cases that you initially expected, or what are the blockers there, and how do you see that, or too difficult to guess?
These unexpected use cases surfaced a lot of problems that I think are real. I think there's like I think we need multiple concurrent leaders, and like the ability for applications to prioritize market maker cancels before takers, like all that stuff that needs to be implemented before TradFi really takes these systems seriously, because like not even like the launches themselves, like I think are like a BD problem. Like you've seen a lot of like really extractive launches launched by like terrible people that should all be nuked from orbit. Like that stuff I feel like is like business development. You just need more robust platforms that have better enforcement and stuff like that. But on the network layer itself, there's a whole bunch of microstructure problems with the way that transactions land and how MEV works that I think need to be fixed and addressed, for me to feel comfortable with like people's 401ks running in these things. Like that's like, I think with meme coins and NFTs, it's like the stakes are medium, like the volumes are real and the numbers are real and there's real money at stake and people really need to take it seriously. But we're not yet like dealing with like people's savings, right? And I want the network to be so robust that I can tell like you should, don't trade on Nasdaq, trade on Solana. Like it's going to be better pricing for people. It's more fair, more transparent. That's the ultimate goal, because like there's a whole. I was more, and I thought it would take 4 years ago. I would have said we're ready in a year. Now I'm like, shit, this is gonna take 5 years to fix. Just those problems are so hard.
Then maybe just one more pushback on the thesis of it needs to be faster and it needs to be. I have an alternative thesis that I think there is pretty good literature that shows that at some point, faster systems do not lead to more efficiency, but that there are alternative market structures, namely batch auctions or micro batch auctions. And to me, that seems like a very interesting approach.
Oh, I
That
agree
has
with
been the
you.
approach that I have always been pushing for blockchain, because if you have a block, then in a way that is kind of, you can see it as a batch, and you can try to do things like single price clearing in this in this block. So that is, in my view, kind of a counter route to this. We just need to be faster to solve things.
I actually agree with you, but I think my batch auction is 100 milliseconds.
Fair.
Not
Fair, not 12 seconds. Yeah.
Yeah.
But I mean, I think my counterpoint would be, how many real world events really happen in 12 seconds? So I mean, I see this theoretical argument that if
Well, to beat Nasdaq, I think we need like the latency to be basically the round trip around the world, and for the inclusion latency to be shorter. So local block producers that are concurrently within this 120 millisecond auction. I think at that point you can reasonably argue that it's as good as price discovery, assuming there's no like MEV extraction. We solve that. Throw some salt over, knock on wood. Uh, if we solve those problems, I think it's very hard to argue that a faster system is more than marginally better. I think at 12 seconds, you have like this information games that are still harder to solve, because you literally can go to Nasdaq, take the trade, and then arbitrate against the chain. And like that's the opportunity that I want to, like, once you eliminate that for the most part, then trader that sees that Newswire and Bloomberg, they look at the chain price or Nasdaq price, it's the same price, then it's as good, you know. But like I agree with you. You don't need to go to like below that latency for a global system, because the world, you still have like the event that happens in Singapore still has to go travel to New York, right? So you have still these embedded latencies that are on the order of, you know, round trip time around the world.
Yeah, and I mean, I think with regards to the whole, finance coming on chain and stuff, I do think there's a huge upside, even with all of this, meme coin DeFi stuff, is that, in the end, a lot of the infrastructure, right, the applications, the ability to compose different protocols, to collateralize one thing and the other. And I think there's just so much happening there and so much progress there. And then I think once you plug in more traditional financial assets in there, you'll just have a very powerful system.
Yeah, on the plus side, if your risk engine survives meme coins and crypto, it can deal with like real world assets that are much more stable. That's the hope, at least.
Is it fair to say for you, blockchain means financial applications, or do you see other things?
It's a good question. I think it is like kind of melted with the internet. Like if you have truly global payments with no friction, everyone can pay everywhere. That's very different than the way the internet works now, because because you don't have money on the internet, you have all these subscriptions and all this kind of friction that created these silos
and
around
ads as a business model instead of just
So like, and that model silos everything, right? YouTube wants its own silo, like Facebook wants its own silo, and they're fighting each other, right, for market share. You still have some of that, but I feel like just making it easy to pay everywhere and everyone could start unraveling it in a more open way. And I like the web. I like the idea of like, minimize the cost of publishing and like let the free market figure it out, right? Like I think that's cool and kind of a really cool, beautiful thing. think the finance will unlock a lot of other use cases that I'm hoping are disruptive to the big tech monopolies, but we'll see.
Cool. You want to share anything else that's like on your mind at the moment?
Solana Mobile is coming out soon, so stay tuned.
Oh yeah, the
we
Seeker
built a
phone.
Yeah, Seeker. We're trying to disrupt the duopoly.
What's your hope for the phone, and like what do you see as the role of the phone?
So the goal is to get enough crypto people in the same ecosystem to where developers have like a distribution channel. And there's like 150,000 pre-orders. That's a reasonably sized group. For a crypto app that's actually like 50,000 daily active users is huge. So if we were able to capture the right kind of audience, and there's a high probability that we were, because people had to pay $500 for a crypto phone. Those are kind of the users that you want as a developer in crypto. So they have money and they're already crypto native. If you can build apps for them that keep their attention and they're like super cool, you're saving money on the 20 to 30% rake that Apple and Google charge. We talk about disrupting finance. They charge basis points. Apple and Google charge thousands of basis points. What is that, like 3,000 basis points, right? Or whatever. It's absurd rake. It's just crazy that for like 20 years now that they've been able to get away with it. So to me, that like massive rake that they take seems like an opportunity, because if devs can distribute to crypto users and there's enough high spending users in that distribution channel, they will actually look at their like top 1% users that are the spendiest users in iOS or Android and literally give them the phone for free, or like offer them incentives like through airdrops or whatever. That's the hope, that we can get that flywheel working. If it works, then that's like a huge opportunity.
How strong will be the connection between the phone and the chain? I mean, I assume there will be by default a wallet on the phone.
Yeah,
or,
there's an embedded wallet and an enclave to run the seed phrase, and there's a bunch of work to kind of unify the experience so people don't have to switch UI. It's more like Apple Pay. That's the goal. I'm actually not like opposed to adding Ethereum support or anything else in the future. It's just these are like iteration times with hardware so long. So it seems like we've been at it for a while, but this is just like the second release. It's got to keep the team focused and ship,
And I assume technically it's based on Android, or
Yeah,
it's
it's
all
Android.
complete. Yeah.
Vanilla Android with the enclave kind of wallet signing feature added.
Yeah, no, I mean, good luck with this initiative. Certainly think the
We'll see.
duopoly reserves, should get more competition.
If we lose because they compress their fees, then that's the beauty of capitalism. Then that worked, right? Like a competitor was able to change the equilibrium in the market, and that's an awesome outcome.
Cool. Well, thank you so much for coming on, Anatoly. It was really great to have you. And super excited about the Solana roadmap and the pace at which the ecosystem is moving, and all of the things that are ahead.
Thanks for having me. This was super fun.